Hi,
So
good
you
morning.
can,
My name is Dan Bratshpis. I run the third largest TLC insurance program in New York City. Since my time is limited, I won't read from the detailed document you're going to receive from me, which outlines why parts of these proposed rules are bad policy at the worst possible time. Instead, I want to take a step back and examine how we really got here. The New York City TLC industry represents 20% of all liquidations in the entire state of New York. And that isn't even taking into account the future liquidations that we're going to see given all the recent press. So think about that for a minute. Across all the different types of insurance transacted in the huge state of New York, this agency's insurance requirements will cause more than 1 out of 5 bankruptcies that the citizens of New York will have to bail out. The Public Motor Vehicle Guarantee Fund, meant to protect the TLC policyholders, currently has a net balance of a whopping $7.5 million, while we have $1 billion of unfunded liabilities from the insolvent carriers the TLC accepts to this day. Each TLC licensee will be held responsible for over $10,000 per vehicle in unfunded claims expenses. And this number is growing because this commission has allowed insolvent carriers to satisfy your insurance requirements. This is just wild. The industry will continue to be plagued by mismanaged and insolvent insurance carriers until real financial standards are put in place by the regulators. These responsibilities lie both with the Department of Financial Services and the New York City TLC. Every other New York City governmental department places financial standards on its insurance requirements except the TLC. To fix a pothole on Broadway, you need to bring an AIM Best rated insurance policy. But to transport a family in a cab, you allow insolvent carriers to protect them. The proposed rules today will not solve this catastrophe. It will push stable insurance companies like ours out of the market. There are 2 parts to the proposed rules you're debating when it comes to insurance. One is to prohibit insolvent carriers from writing TLC insurance, and the second is to push out surplus lines insurers. I've been told that the commission intends to scrap the insolvent carrier rules altogether. In other words, you're going to continue allowing insolvent carriers to protect the citizens, pedestrians, tourists in New York City, all while unfunded liability gets bigger and bigger, and you're proposing to kick out the only AM Best rated financially stable insurance program in the city of New York, effectively leaving one solvent carrier in the market. The TLC has as much a responsibility here as the DFS to solve the insurance.
30 seconds remaining.
The department should address 3 core areas. 1, stop allowing insolvent carriers to operate in our city by setting minimum financial standards. Having $1 of capital is not good enough to protect the citizens of New York. It's absurd that we even need to debate this. 2, we need to attract financially stable insurance carriers into the market by continuing to allowing pricing flexibility through surplus lines in the free trade zone, just as the TLC has allowed for 40 plus years. And 3, set coverage requirements so that there are no gaps via the rules in the same way that California does, ensuring the coverage is maintained 24/7, 365.
thank you. Our next speaker is Greenbaum.
Good morning, Chairman Doe, members of the Commission. My name is Keith Greenbaum. I'm here today speaking on behalf of Hereford Insurance Company. Hereford is a New York State domiciled admitted insurance company. We have provided insurance services to the for-hire market in New York City for 30 years. The company is based out of Queens and employs approximately 250 employees. We work with more than 100 New York licensed insurance brokers across the state. Hereford is a responsible and disciplined insurance company and is proud to have successfully supported this vital industry with insurance coverage throughout the last 30 years. That said, we very much recognize the issues within the broader TLC insurance environment. We agree that New York City and New York State must focus on solutions to these issues. Such solutions should minimize disruption to the streets of New York and create a stable, competitive, and healthy insurance marketplace for the for-hire industry. That is why we support the intent of the rules as proposed. We view the proposed rules as providing elaboration or clarification of the already existing rules. We agree with comprehensive reporting, clarifying that TLC minimum limits be met through a primary policy, and that insurers providing this coverage be licensed and authorized by the New York Department of Financial Services, also referred to as being an admitted carrier. The value of being an admitted carrier is substantial. Admitted carriers are subject to strict compliance with state rules and regulations that non-admitted carriers are not subject to. Admitted carriers are required to have premium rates, rules, and policy forms approved by the DFS through an established approval process. These consumer protections protect against unfair premium charges, deceptive policy terms, and unfair claims handling. Significantly, policies issued by state admitted carriers are protected by the state's guarantee fund. Therefore, if an admitted insurance company cannot pay a claim, the fund will step in. Hereford, by virtue of being an admitted carrier, pays an annual 3% liability premium assessment to New York State's guarantee fund. Non-admitted carriers do not pay into the fund, and its policyholders and claimants are not afforded the benefits of the guarantee fund. Allowing non-admitted carriers to write this business would not only jeopardize the writing public, but it would harm the admitted insurance market and create a new, unstable, and unsecure insurance market in an already vulnerable marketplace.
30 seconds remaining.
In today's environment, ensuring that licensees are covered by licensed companies subject to the laws and regulations of the state and financially covered by the state's guarantee fund is common sense. This industry needs to solve its problems with reasonable regulation, not deregulation. Accordingly, the rules proposed would clarify and protect this industry from creating more problems, which frankly, this industry could no longer afford. I appreciate your time. I'm available for any questions. Thank you.
All right.
Questions?
Go ahead, Paul.
Am I the only one? So, Mr. Greenbaum, thank you very much. We've heard testimony. We'll hear testimony on both sides of this issue regarding the first part relative to the solvency. Some people are saying it's not strict enough, that there should be a stricter criteria based on a credit rating. I'm interested in what your thoughts are about that, and what you think the impact would be if we made it stricter on the solvent, stricter on the economic financial side.
I think that the DFS is, I don't think that the solution to the crisis is the DFS needs to do a good job regulating its insurance companies. That is its sole purpose. And I think that it is now committed to doing so, and that the DFS is the appropriate entity to regulate insurance companies. And their purpose is to license responsible insurance companies. Now, if there's been a failure in the past, then that needs to be corrected. But it's ultimately their responsibility, and they are well suited to comply with that responsibility.
Okay, so on the other side, in the past, there's been some surplus providers, as you are aware, that have provided lots of insurance for in the industry over the years, and it hasn't really created problems as far as we know. So why is it that you would want to change that and no longer allow those providers to continue to insure?
I'm sorry, I don't understand the question.
In other words, you support the proposal to get rid of the surplus providers, correct?
No, we were under the understanding, based on the opening dialogue, that language was being changed simply to. We didn't really comment on that piece of the legislation. We were under the impression that that's being modified.
Okay. So we are aware, of course, that almost 65% of all the insurance for the TLC is handled by one company that has real solvency problems, correct? So we don't know exactly. We all agree that the state is doing what they can to deal with that issue. We all hope that works out beneficially. I don't like to have. It's not a good situation where 65% of the policies are written by a company that is the weakest financially of all the insurance companies. What do you think? How do you think that should be dealt with?
I agree with that. I think that the solution is baked into adequate pricing, appropriate and reasonable regulation, and enforcement of the existing rules. And I think that this is a collaboration between the city, the state, and the stakeholders. And I think that priority number one is to minimize disruption to the streets of New York City. Number two is to stop the bleeding of any additional insolvency through adequate actuarially determined rates, and then to incentivize and encourage other carriers into this marketplace with a healthy, competitive marketplace.
So I'll give you one more question. If hypothetically come March, when a lot of these policies are up for renewal, this large carrier is not able to adequately provide, do you think that the rest of the insurance industry in the area would be able to pick up that slack?
I think that could definitely be considered disruptive to the streets of New York City, and that's not our objective.
Okay, thank you.
Thank you. Our next speaker is Jeremy Moskowitz.
Thank you. Commissioner, thank you. And I want to say that when we speak one-on-one, I appreciate that you always, I feel, listened to and heard. With that said, these insurance rules show to me that the Commission's understanding of the current insurance crisis is uninformed, irresponsible, and ill-timed. We've seen what happens when TLC makes quick rule changes without proper research, process planning, or consultation with the important stakeholders. The chaotic and surprise release of the EV licenses is proof of that. I want to take a second to emphasize that rental is critical to this industry. Thousands of drivers and our partners at the IDG see that. For tens of thousands of first-generation New Yorkers, they need a solution that allows them to go abroad for 2 or 3 months without paying fixed costs like insurance and interest, etc. Even the safest driver can get rear-ended and their car is in the shop for a month and a half and they need to rent. Others who've fallen on hard times don't have the credit to finance a vehicle, and they use rental to succeed in this industry. Back to insurance. Rather than trying to prevent attic or park insurance from happening again, rather than finding a real solution to the New York City TLC insurance crisis, you're passing a rule that only exacerbates it for those of us who are operating responsibly, as Commissioner Bader just mentioned. This would have a direct increase on rental prices in New York and an unnecessary increase. I would rather pass that savings to drivers or invest in newer hybrid and EV vehicles. I think this is a one-way street, so I can't really ask this question, but I'd like to know how being a fully admitted policy helped park insurance, which screwed many of us. How being a fully admitted policy helped the DFS oversee attic for the last 30 years as they operated a completely irresponsible but fully admitted policy that some would call, not me, but others would call maybe a Ponzi scheme. How has New York State DFS oversight helped here? We have an excess or surplus policy, as the commissioner mentioned. Our main policy is fully admitted by New York State, and our excess policy is completely responsible. I have 3 times as many actuaries looking at my loss runs and my insurance policy's loss runs than DFS has looking at any of the other insurance policies in the market. My policy has an A rating from the only national gold standard rating agency, AM Best. That means the insurance policy is backed by INSHUR with a proven record of billions of dollars in assets. And since our insurance is captive in Vermont with the actuaries that I mentioned that look at every little corner, I have tens of millions of dollars in assets in addition to that protecting our insurance policy. It's not even a competition to compare my insurance to Attic and Maya and others. You've already have my proposal in writing that this excess policy should be allowed with an AM Best rating. And if the TLC continues with this rule without a clear study and conversation with stakeholders on how this specific rule helps prevent future attic or park insurance, or you can't articulate how my insurance is more risky, then I'll feel compelled to go to the city council and see how they can intervene to create that conversation publicly for all of us for safer streets. Thank you.
Thank you. Our next speaker is Jose Altamirano.
Good morning, commissioners. My name is Jose Altamirano. I'm the president of Livery Based Owners Association and the owner of El Barrio's Car Service, a livery based in East Harlem, considered Northern Manhattan. LBO represents 20% of the FHV sector. We understand and support the TLC's goal to ensure that all vehicles operating under its jurisdiction maintain adequate insurance coverage. We are currently in the midst of an insurance crisis in the FHV industry and welcome updated laws and regulations to ensure that our affiliated vehicles can operate safely while allowing the drivers to earn a living. While we support the proposed regulation, we strongly urge the Commission to implement these changes in a way that does not place additional administrative or financial burden on FHV bases, which are already facing significant challenges. It is critical to highlight that drivers in the livery sector and the rest of the FHV industry are independent contractors, not employees. Bases send them jobs while they accept at their discretion. Drivers are responsible for their vehicles, including maintaining appropriate insurance coverage. Our concern is that the proposed requirements for a policy detail submission and compliance monitoring may be interpreted as a duty of the livery base rather than the vehicle owner. While we assist our drivers with administrative matters from time to time, we must ensure that these new mandates do not shift responsibility and cost onto our member bases. Financial pressures could discourage new drivers from entering the livery sector and drive existing drivers out, further reducing our already limited service availability for the passengers we serve. We respectfully recommend the following prior to adopting the proposed rule: clarify base responsibilities, ensure that any administrative changes explicitly state that the bases are not responsible for directly managing or monitoring individual driver insurance compliance, support for small businesses, provide resources such as training or technology support to help bases assist drivers in adapting to new requirements without incurring additional costs, engage stakeholders, which is maintaining an open dialogue of FHP bases and drivers to assess the impact these changes and adjustments implement as needed. We are committed to working with the TLC to achieve its safety and compliance goals by balancing these priorities with the operational realities of bases like ours. We can ensure a thriving, equitable transportation ecosystem for all New Yorkers. Thank you for your consideration.
Okay. Thank you. And our next speaker is Andrew Greenblatt.
Hi, good morning. Good morning, Commissioner Doe and the Taxi and Limousine Commission members. My name is Andrew Greenblatt, and I'm the Policy Director of the Independent Drivers Guild, otherwise known as IDG. Thank you for this opportunity to testify regarding the proposed regulations relating to insurance requirements for FHVs. First, I'd like to apologize for the sparse attendance today of IDD drivers. At this very moment, hundreds of IDD drivers are participating in a caravan that's calling for a fair pay increase, an end to the lockouts, and a solution to this insurance crisis. This meeting is just about the insurance issues, so I will talk just about that. Today, I'm going to comment on two of the proposals. The first would require drivers to ensure that the insurance they are required to have comes from, quote, a solvent and responsible company. The second would require that all coverage, quote, must be provided by a single primary policy. First, the proposal to require drivers to determine if their insurance is solvent and responsible or face a fine would be nothing short of regulatory malpractice. The state of New York Financial Services, Department of Financial Services cannot adequately determine this with their team of accountants, actuaries, and lawyers, all with subpoena power. It is unreasonable to believe that any driver could effectively make this determination, much less every driver. Furthermore, the state has recently disclosed that insolvent companies cover close to 70% of the existing market, and if that were forced to go away in one foul swoop, it would be very disruptive to the existing market. Second, so just to be clear on this, we oppose this rule change completely and in the strongest possible terms. The second proposal would require drivers to have a single insurance policy rather than a primary and secondary, and our response to that is more nuanced. The current regulations, allow for the $50,000 and then the excess $150,000 to be from a secondary carrier. What this allows today is for the secondary carrier to skirt consumer protections and contributions to the guarantee fund. We agree that all carriers should play by the same rules concerning consumer protections and the guarantee fund, but we disagree that the commission that the best way to do this is to forbid any companies from creating split coverage. Instead, we urge the
30
commission
seconds
to ban
remaining.
non-admitted carriers and allow insurance companies and brokers to continue experimenting with split coverage, hoping to lower bills and to bring much needed new companies into the market. I'd be happy to take any questions, and I would really encourage Commissioner Bader to re-ask me the same question as to what to do about American Transit. My time is up.
Andrew, on your first point, I think I made it clear is that we're going to make those changes to ensure that there is still competition and the appropriate carriers in the market to fulfill and renew all policies that are currently out there. And then to your second point, if you can clarify both the primary and secondary should be an admitted product?
Yeah, so to be admitted, there's all kinds of consumer protections that the state requires, and also that they toss in their 3% into the guarantee fund. I think that's right. Like, you shouldn't be able to charge less because you're doing less. So as long as they're meeting the same requirements, and then can get admitted, let that go ahead. There is this loophole right now, and I think you're trying to, I don't know what's in your heads, but I think you're trying to close that loophole and say, well, since the primary has to be admitted, by fusing the two together, we'll make sure that this unadmitted secondary goes away. The problem isn't that there is a secondary. The problem is that it's unadmitted. So solve that narrower problem. Don't get rid of what could lead to experimentation and more insurance companies entering the market, which we so desperately need.
Okay, we'll take a look at both points, but I think on the solvent versus insolvent question, we're definitely going to make that change.
Yeah, it just shouldn't be on the backs of the drivers. Like, they can't figure this out.
I agree with you, Andrew. And so overall, if we make those changes, IDG will be in support.
We reserve the right to see what you come up with. But yes, those are the two things we're calling for. Thank you, Commissioner.
I appreciate it. Commissioner Bader, do you want to ask your question again? I don't think this is just an appropriate time to look at the broader.
It was worth a shot.
Very specific on a very narrow. So I don't want to bring more into this conversation than just the narrow aspect of what we're addressing here today. Is that okay, Commissioner Bader?
Yes, that's fine. I understand that. I mean, right, we have more to go on this. There'll be more discussions on this certainly going forward, and we'll hear more from IDG and the other interested parties going forward before we have to make a final decision, certainly.
Thank you, Andrew. I appreciate your time today.
Thank you for the opportunity.
Okay, our next speaker is Cira Angeles.
Good morning. My name is Cira Angeles on behalf of the Livery Base Owners Association and CEO of the Riverside Brokerage. Our organization works closely with Base's drivers, helping them navigate complexities of maintaining insurance coverage in an increasingly challenged environment. We fully support and commend the TLC for its ongoing efforts to protect drivers, passengers, and businesses in the industry to the proposed rules. The DFS, or Department of Financial Services, through admitted carriers, has helped sort of stabilize the TLC marketplace. Admitted carriers become insolvent if the state's guarantee fund can step in to pay claims, providing an essential safety net for policyholders and claimants. On the other hand, if a non-admitted carrier goes bankrupt, policyholders have no such protection from the state guarantee fund. Currently, there are several insolvent companies operating as admitted carriers. If these companies were not admitted carriers, the crisis in the TLC insurance market would be far worse. It will be catastrophic, to say the least. Non-admitted companies could simply exit the marketplace, leaving hardworking drivers without coverage and facing the financial burden of unplanned accident claims. Take, for example, American Transit, recently in the news with decades of insolvency. But despite the situation, it has been supported by the State Insurance Fund, showcasing the value of regulatory protections. This highlights why the TLC proposed rules is a practical and necessary measure. Non-admitted companies lack the security and oversight needed to protect drivers, bases, and passengers. It is critical not to be misled by claims that hybrid insurance structures offer equal protection, because they do not. If a company with such structure leaves the market, drivers are left without the support of the state guarantee fund. Drivers often face challenges understanding the complexities of these insurance policies, and this makes them vulnerable to predatory non-admitted companies that prioritize market share and profits over claims and supporting policyholders. In today's challenged insurance market, such a mandate can leave nearly all drivers out of compliance. Addressing systematic issues within the oversight of the insurance industry and fostering the collaborative environment is the way forward. That is why the LBO is working closely with the DFS, Commissioner Doe, and industry leadership to bring solutions and ensure no compromises are made and prevent companies from entering a highly regulated industry without proper oversight. Once again, we commend and congratulate the TLC for introducing this common sense rule. We remain committed to measures that are pro-driver and prioritize consumer protections. Thank you.
Thank you. Our next speaker is Scott Wollney. Mr. Wollney, unmute your mic.
I'm sorry, can you hear me now?
Yes.
Excellent. Thank you very much for the opportunity to testify. My name is Scott Wollney. I was the president and CEO of a group of insurance carriers who for many years provided commercial auto insurance for approximately 15% of TLC plated vehicles in New York City. We are currently not operating in the New York market. I express my appreciation for the actions taken by the TLC to prevent a potential crisis that threatens to displace tens of thousands of drivers from their jobs and create increased wait times for passengers who rely on their services. We believe there is an opportunity to re-enter the New York City market with a meaningful amount of new capacity to support future business, provided that the changes under consideration result in an environment that enables healthy and fair competition among responsible insurance carriers and providers, with collaboration between the various public and private constituents in this important industry. Consistent application of reasonable and appropriate rules is essential. This will provide drivers and operators with access to coverage that legitimately protects them, along with passengers and the public. Providing clarity regarding insurance requirements in the near term will enable interested parties to organize the capacity necessary. It will take time, and I encourage the Commission to include a reasonable phase-in period before any changes take effect. Comprehensive solutions are needed, including these key points which are further detailed in my written comments. Implementing telematics and onboard video surveillance will foster safety and reduce claim expenses. Delivering comprehensive data and safety profiles to the industry in a timely manner will improve driver training and link insurance costs to actual risks. Reforming no-fault insurance thresholds will align insurance requirements with actual risk levels and ensure a fair insurance system for all parties involved. And undertaking a comprehensive study to examine the root causes contributing to the current industry challenges will identify the best long-term solutions. The current proposed rulemaking references solvency and responsibility. In order to attract capacity from solvent and responsible carriers, helping to control underlying expenses relating to factors such as potential fraud and inflated claim costs is important. Carriers will need to be able to provide coverage at an appropriate price to support the risks they're covering, which will also require support from the New York Department of Financial Services. Any near-term approach that limits competition and results in a coverage vacuum will immediately impact tens of thousands of individual drivers in the 5 boroughs. Insurance prices will necessarily go up, but the impact can be mitigated. Any proposed regulations must be implemented in a manner that allows for a sufficient period for DFS to take appropriate action and for the industry to work together to solve the problem. I'm currently operating a managing general agency that's actively writing public automobile insurance in approximately 20 states, but not New York, based on historic challenges. We're extremely interested in deploying our experience and infrastructure to assist. However, time will be necessary to fully resolve this crisis. An aligned and collaborative approach among the industry and regulators will help to shorten this timeline and protect drivers and operators in this important industry. Thank you for your time today. I'd be happy to participate in future discussions regarding potential solutions.
Thank you. Our next speaker is Kamal Ahmed.
Good morning, everyone. Can you hear me?
Yes.
Good morning. This is Kamal Ahmed. I represent my Bangladeshi drivers community that accounts for almost 20% of entire 200,000 TLC drivers. Today, I will speak on the amendments of insurance requirements. At present, FHB drivers are suffering limitless problems, you all know. More expenses, less opportunity. I never hear any initiative that really benefit the drivers who does extra amount of work for the sake of their family, and end up accidents we call bad drivers. We cannot call them bad drivers because of their circumstances. Drivers are the worst victim of rampant insurance fraud. For example, American Transit Insurance Company that has 60% market share in this industry. This company plans to file around $300 million as a fraud claim this year. So this company produces 25,000 medical bills every month. We are aware a lot of medical billing fraud. So my question is, who is paying the bills? The fraud, the claim, is the driver or the insurance company? And ultimately, the drivers are the worst sufferer. They are suffering as a result of the loss. And amid this situation, DFS, they suggest to increase the rates of insurance, but that does not help. It's gonna be eaten up again. So insurance rates will trigger more fraud billing, medical billing. My question is there any amendments are going to be enacted to curtail the fraud in this AFHB industry? And also, is my community, I mean, the Bangladeshi drivers community, will see any regulatory measures that will help increase the livelihood of the drivers? And thank you so much for giving me this opportunity.
Thank you. Our next speaker up is Avik Kabessa.
Good morning, commissioners. My name is Avik Kabessa. I'm the CEO of Carmel, a board member of the Livery Roundtable, and the chairman of the New York State Livery Workers' Compensation Fund. The Livery Roundtable represents 200 livery bases, and we strongly support the proposed rule on insurance. Admitted carriers claims are protected by the state through the guarantee fund in case they go out of business. Non-admitted carriers' claims are not. So in this case, consumers are left with no safety net and will go after the driver for payment. To add an insult to an injury, only the admitted carriers are paying into the guarantee fund. Non-admitted do not. Admitted carriers are regulated to act in the best interest of the public. Non-admitted are not. Let's face it, we all like to pay less for insurance. Non-admitted carriers oppose the proposed rule, looking to bypass regulation, contribution to the guarantee fund, and offer cheap rates. To the non-admitted carriers who spoke today, first I want to correct you and tell you that I was personally present in many events where Commissioner Doe has done intensive due diligence on the issue. And with it, I have only one question to them. If you're such an A-rated carrier and so superior to the current admitted carriers, why not become an admitted carrier and show them how it's done? Some drivers may also oppose the proposed rule so they can buy cheap insurance. Who wouldn't? But with no regulation, no accountability, and no one to secure claims, when God forbid an accident happens, cheap becomes very, very expensive. The one thing we will ask the commissioner to remove is the solvency condition. Solvency is a fluid situation. DFS has the power to force an admitted carrier to take action to prevent and or reverse insolvency. So admitted carrier may move in and out of solvency. If we adopt the solvency condition, it will run a chaos in drivers stepping in and out of compliance with this TLC requirement. The TFS ability to deal with the insolvency or risk of insolvency of an admitted carrier, but not with a non-admitted carrier, further strengthen the fact that non-admitted carriers should not be allowed. From what I understand, Commissioner Doe, you're amenable to remove that requirement, so thank you for that. Therefore, we strongly urge the Commissioner to vote in favor of the proposal after, as I said, omitting the solvency requirement. Thank you very much, and I'm here to answer any questions.
Thank you. Our next and final speaker is Mike Rose.
Good morning, Commissioners. My name is Michael Rose. I'm the president of Chauffeured Transportation Association of New Jersey, formerly the Limousine Association of New Jersey. Thank you for the opportunity to testify today. The members of the Chauffeured Transportation Association of New Jersey provide prearranged chauffeur-driven transportation to corporations and private clients throughout the region, especially New York City. Members must be fully licensed and insured and adhere to all applicable safety laws for our services. We play by the rules, but the proposed rules at issue will create unnecessary financial burdens to our members licensed by the New York City Taxi and Limousine Commission. The TLC has proposed amendments to its vehicle insurance requirements that could significantly impact the for-hire licensees, particularly those drivers who reside in New Jersey and are members with TLC bases. The proposed rules stipulate critical conditions regarding the names on the insurance policies and the vehicle registrations, potentially creating complications for many operators. One of the core proposed changes, 35 RCN NY 59A-12C7, mandates that the name of the policyholder on the insurance must match exactly with the name of the vehicle registrant. This presents a considerable challenge for FHV licensees in New Jersey and other states, since the regulations in these states differ from those in New York concerning leased vehicles. The effect of this rule is to prevent New Jersey-based TLC drivers from leasing their vehicles. This creates an incredible financial burden on these drivers who currently lease their New Jersey registered vehicles. For a driver, the cost to buy out a lease can exceed $30,000 for a sedan or SUV. For a TLC base, that could cost easily more than $1 million to buy out those leases. But that is what this rule would require. If American Transit Insurance closes its doors, the expected higher insurance cost will be a double hit to these drivers and our member bases by the New York City TLC. New York allows a leased vehicle to be registered in the leasee's name. However, New Jersey law 39-3-4 necessitates that the lessor of a leased vehicle be the individual or company listed on the vehicle registration. As a result, FHV licensees who reside in New Jersey and other states with similar leased vehicle registration requirements would be precluded from leasing vehicles. Only FHV licensees residing in New York could lease vehicles. This proposed rule change contradicts the definition of owner in the New York City Administrative Code. According to the New York City Administrative Code 19-502, an owner includes a leasee of any such vehicle or vehicles under a written lease. Currently, many FHV companies and individual drivers who reside in New Jersey lease vehicles, and the registration for those vehicles does not reflect their name or the name of the company that holds the FHV license. Until now, the FHV has allowed the city's regulations and recognized a leasee as the owner of the vehicle for FHV licensing purposes. If this rule change is implemented, residents of New Jersey and Connecticut with FHV licenses who lease vehicles will have to make difficult choice either to purchase or finance vehicle outright to comply with the new regulations or surrender their licenses. This could lead to significant financial strain for many driver owners and fleets, possibly pushing current operators out of the market without any clear regulatory benefit to the TLC. The backdrop of these changes with the ongoing insurance crisis for the for-hire industry prevents our operators from continuing to serve the riding public. Thank you for your time.
Thank you, Mike. And we'll look into your written comments as well.
Thank you.
Obviously, we don't want unintended consequences to a rule proposal. And so we'll take a look at it with our team to make sure that some of the points that you've raised are looked at. Thank you so much.
Thank you, Commissioner. And those written comments were submitted, so thank you very much for your consideration.
All right, Mr. Rose is our last speaker. Commissioner Doe, do you wish to close out the hearing?
Well, thank you everyone for your comments. We are going to take a look at all of them and propose the final version of these rules that make some of the changes that we heard today. And we'll move forward. But thank you so much for all of the commissioners for also being here today and for their input as well.